Good afternoon and welcome to BDO's Financial Reporting Update webinar. I'm Moses Surfety and I'm joined today by Anthony Appleton, who is a partner in our technical financial reporting team. We expect today's webinar to be over within the hour, probably about 50-55 minutes. There's hopefully be time to answer your questions. If you would like to ask any questions, please use the Q&A function, which you can access from the icons at the bottom of your screen. Time permitting, we'll try to answer the questions during or at the end of the webinar, or if we don't have enough time to do that, we'll get back to you after the webinar via email. But if you should be aware that if you ask a question anonymously, we won't be able to respond to you via email. Just also a reminder that a recording of the webinar together with the slides will be available online, and we will send all the slides to registered participants after the webinar. So if we move on to the next slide. So what's on the agenda today? First, we'll be looking at some recent IFRS developments. You'll notice that there's nothing on UK GAAP, but there's not been much since our last webinar, but we expect to cover UK GAAP at our December webinar. Secondly, we'll be looking at sustainability and climate change reporting updates. Excuse me, in particular focusing on entities that have to comply with the TCFD. And then after that, we will be looking at other corporate reporting news, and you will see that there's a theme. We're going through some FRC reports with. So if we move on to the next slide. So moving on from that, so what do we have in terms of IFRS updates? So we've got 3 new IFRS Interpretations Committee agenda decisions. And just going through them, the first one is on negative low emissions vehicle credits. And what was the question that was asked there? So some economies are wanting to stimulate green technologies, and in order to do that, they've got a credit or debit scheme whereby companies that produce or import vehicles whose average fuel emissions are lower than a target set by the government will get positive credits, and conversely, if the vehicles that you produce or import exceed those thresholds, you get negative credits. And the way the scheme works is that the negative credits need to be eliminated by the following year, and they can be eliminated either by purchasing positive credits from another entity or by generating positive credits by the company generating positive credits itself by importing greener vehicles or producing greener vehicles. Another feature is that the government can impose sanctions on the entity if the negative credits are not eliminated, for example, by restricting the entity's access to the market. And the question that was asked was, well, does this meet the definition of a liability in IAS 37? The committee concluded that this would give rise to a liability within the scope of IAS 37 unless accepting the possible sanctions that could be imposed was a realistic alternative, in which case no liability under IAS 37 would be required. Now, in terms of this agenda decision, it is probably quite narrow in focus, but I suppose the instructive thing about this agenda decision is how it walks through the process in some detail in order to determine whether or not that there is a liability under IAS 37. And firstly, what it does, it is analyzes the activity. And what's the activity that past event that you've got to have in order to have a provision? It's the import or production of vehicles. Then it walks through, well, what are the alternatives? Do they involve an outflow of resources? And the conclusion is that yes, they do. And then there's some analysis on the sanctions and what that is that's an enforcement mechanism. So I suppose it might be a useful template to walk through when you've got a decision to make on whether there is a liability under IAS 37. Then the next two are rather narrower in scope. So the first one is about special purpose acquisition companies, and the committee was asked, well, where some shares have perhaps a demand feature, do they meet the definition of a liability, or are they equity? And in particular, in the scenario that the committee was asked, was that where the shareholders can vote to extend the life of the entity, does that then mean that such a decision is within the control of the company, and therefore, even though these instruments might have a feature that allows somebody to demand cash because it's within the control of the entity, it would not be treated as a liability. The agenda decision identified that IAS 32 does not provide any requirements on how to assess whether a decision of shareholders is treated as a decision of the entity, and they concluded that this was not a subject that they could come to a decision on, and that it should be considered by the IASB as part of its FICE, or financial instruments with the characteristics of equity project. So that's a bit of a holding pattern on that one. And the next one, again, is also quite narrow in terms of it's a decision about the application of IFRS 17 and about specifically how an entity determines the amount of contractual service margin to recognizing profit and loss in a period because of the transfer of insurance coverage for survival in that period. Again, quite narrow in scope. Again, just a reminder about implementation of agenda decisions. Even though they are sort of effective immediately, the IASB has said that they will allow entities time to implement these. So if systems or processes need to be changed, there's no need to rush that. Although clearly you wouldn't want to leave it too long. So moving on to the next slide, and this is one I think where we've been talking about it for a while, by way of background, the fact pattern is that, and it's similar to what we would have here in the UK for BACS, where you initiate an electronic transfer and it takes 3 days to hit the counterparty's account, not 2 or 3 days. So there was a tentative agenda decision issued by the Interpretations Committee, which said you do recognise the financial assets when the contractual rights to the cash flows from the financial asset expire. So if they only expire when the cash is received, you do recognise a trade receivable, assuming you're receiving some cash on the settlement date, i.e. when the cash is received in the bank account. This was taken to the IASB meeting last week for ratification. The IASB decided not to ratify it, but said that it would explore some narrow scope standard setting, and therefore this agenda decision is not finalised. And I suppose the question is, why did the IASB do this? Well, I think there was a fair amount of noise or responses from market participants saying, well, this is going to cause change to existing practices. Also, that the decision could have wider reaching consequences than perhaps initially thought. So that this might seep into accounting for credit card receivables. And also that if this decision was finalised, that then there would be significant costs to implement it, and changes to long-standing procedures and staff training and all of that. So I suppose the question is, well, what might this narrow standard scope setting be? Now, I think that one can't have an expectation that that would be looking to maintain the status quo, but equally, the IASB have said that it would not amend the general recognition and derecognition requirements of IFRS 9, and would likely create an exemption from the general recognition and derecognition requirements for transactions that are similar to the fact pattern. but only if doing so would not significantly reduce the usefulness of the information that would otherwise result from applying these requirements. I think the message is we don't quite know what that standard setting might look like, and where it's going to land, and what it might affect. One thing we do know is that it's not going to happen this year, so this is something that we would perhaps expect next year, but I don't think there's any dates yet in any diaries. So I suppose the question is, what does this mean for preparers? Well, I think it's probably safe to say you're probably better off doing nothing at all, but and keeping your existing practices. But this is something that we will keep under review, and if we see the market changing its practices, I think we will update you at the next webinar. So moving on to the next slide. Again, this is an amendment to IFRS 16, again, rather narrow in scope, and it follows on from a June 2020 Interpretations Committee decision. The question there that was asked was, well, how does one account for a sale and lease back where there are variable payments that are not dependent on an index or rate? So let's say you own a property and you sell it, and you enter into perhaps a turnover rent agreement. There might be some base rent plus some turnover rents, or fully flexible arrangement type of fully contingent arrangement. And the agenda decision said there, well, that you would make an estimate of your best estimate of the liability that you would have to pay under those contingent rent arrangements, and include that in your measurement of the lease liability, which was a bit of a departure from the general existing rule under IFRS 16 not to measure contingent rents that are not dependent on an index or rate. So, but following on from that decision, the question that was asked, well, how does that one then account for the lease subsequent to the initial recognition? So, if there's differences between your expected amounts and your actual amounts, which there would be. And this amendment sets out how to account for it. It essentially gives you two options of accounting for any deviations between your expected and actuals. And one is to, when you measure your liability initially, you would have made an estimate, and then what you can do is any differences between actuals and estimates you would take to P&L and amortize your liability based on your original estimates. A second approach for accounting for that liability is to say, well, you work out what your liability is, but then assume a straight line amortization of that liability using the effective interest rate, and any differences between actuals and that straight line number that you've worked out would go to P&L. So again, rather narrow in scope. It's effective from 1st of January 2024, but it's fully retrospective. So if you have entered into a sale and lease back where you entered into a contingent rent agreement, you probably would want to look at the changes. There's also an example at the back, example 25. It's been added to the standard to illustrate how one might apply those two approaches that I mentioned earlier. So moving on to sustainability, I'll hand over to Anthony now, and I'll be back later.
Thanks very much, Moses. Good afternoon, everyone. I'm going to take you through a few slides on sustainability, or primarily climate change reporting, and primarily to look through what the regulators' findings are after this first year of mandatory TCFD, but to get us there, just a little bit on some of the background as a reminder. So looking at these first few slides. So just so you're clear on the scope of this, yes, at the moment, or at least those who've reported so far under mandatory reporting is purely and premium listed companies for years commencing 1st of January 21. But that is now being extended, and we can really see this as a commitment by the government and by the regulators to extend the level of climate change reporting being done. And so I can only see this being a growing area over the coming years. So during this year, it extends to standard listed companies for December 22 year ends, as opposed to premium listed. But far broader in its application is on the right-hand side there, has been the BERS have finalised their legislation. It's in place for years commencing on or after the 6th of April this year, extending the scope of what is effectively TCFD reporting. I say effectively because it's actually, and the disclosures are set out in the legislation, but they are effectively TCFD aligned, TCFD compliant disclosures. And that's expanded their scope of such disclosures to large pies and including large private companies. But it's not just there that we see this. And I think it's one thing to bear in mind with TCFD is if you go back to when this was first created, the task force, it was known, the task force for climate-related financial disclosures was created. It was created by the Financial Stability Board, and it was created by Mark Carney when he was the governor of the Bank of England. This was done for the investment community. This was done for the supply of financial capital. And so one of the ideas that TCFD really majored on was, this isn't just about companies reporting. This is about every player within the supply of financial capital, all the way back from the beneficiaries, members of a pension scheme, pension owners such as the pensions themselves or insurance businesses, through their advisors, whether it's investment managers, fund managers, proxy advisors, sorry, not proxy advisors, but certainly investment advisors, all of those to be providing information that allows everyone that precedes them in that financial capital chain to be able to make decisions about allocating capital in full consideration of climate-related risks. So what we're seeing is, and this is what the middle one is really getting at, is this isn't just about companies reporting. This is about all players in the financial markets having to collate information in order to report back to the ones before them, to those who give them mandates for their work. And then that creates a sort of virtuous circle in a way, or certainly it creates its own momentum, because now that the beneficiaries, asset owners, have the information that allows them to make decisions based on risk, it then forces forward in the mandates they set and saying to asset managers and investment managers and investment advisors to make sure that the decisions they make take climate-related risk into consideration. Now, it might be that you don't think you'll access that or be influenced by that, but then the same applies in banks, where banks providing debt finance are increasingly requiring to report on who they're lending to and the portfolio they're lending to, and whether that is climate-related risk. So for that, they need information about individual companies and the management of climate-related risk. So I think you've got to kind of try and stay it in that context. And that ultimately as well, the other context to bear in mind is this isn't really about reporting at all. This isn't really about making disclosures. The disclosures are meant are there to say, tell us how you are integrating this into your thinking. Tell us how you are integrating climate-related risk into strategic planning, your risk management, your remuneration. How is this? How are you making this relevant to your decision making? And if you can't make disclosures that so it's relevant to your decision making, that creates increased risk down that capital supply chain. And we are seeing some people making investment decisions and proxy advisors giving advice, which is very binary. Failure to provide these disclosures, not they're on the blacklist. We can't invest, or we'll vote against the board. So it really is creating an environment where and proper management of this risk, it becomes an absolute commercial and financial necessity. And moving on then, what are these TCFD disclosures? Moving on to the next slide. Just a quick reminder. Remember, the TCFD breaks down into 4 pillars. Governance. How is this incorporated in your management decision making and your board decision making? Strategy. How is it? What are the risks that you have identified, and how do they impact on your business model, your strategy, your success over the short, medium, and long term? How are you then managing those risks, identifying them, assessing them, mitigating against them, managing those risks, and then provide comparable, consistent metrics to allow investors to make comparisons. I've put some of these within a little red box, and that's what, as we move on to look at what the regulators have been saying. The regulators think that from the outset, every company should be able to do those 7. And these 7 are all about what it is you do, and you should know what it is you do. Writing it down might identify that there's more that you should be doing, and you may find that you've got to work on incorporating climate-related risks into your management processes. But you should at least be able to set out what you're doing now and what you plan to do and how this will improve over time. Anyway, let's move on and look at what the regulators have been saying. And in particular, I want to pick up on what both the Financial Reporting Council and the FCA have been doing in their reviews of annual reports, and then say a little bit about a related lab report. So, starting off with the report from the Financial Reporting Council, or more specifically, their corporate reporting review team, the CRR. What they did was they reviewed 25 companies. Their focus was certainly on where climate-related risk would have the greatest impact. So perhaps not the most generic group for us to really learn from. But given these were the ones who you'd expect to have the most advanced sort of thinking in this area, still they identified that there were challenges. Even those who had been thinking about climate for the longest, weren't able to provide all of the disclosures. Yes, broadly able, but there were gaps. The quality wasn't as good as it could be, and certainly there was a range of maturity in their disclosures, despite that focus on those where the risk would be greatest. Moving on, look a little bit at some of the detail. So I mean, these lessons, I think that the FRC have identified, this is relevant for all sustainability reporting. It's all about improving the quality of sustainability reporting to make it as useful for investment decisions, and whether that's from equity investors or whether that's from banks or elsewhere. So how do you provide good information? You make it as granular and specific as you can. You explain the impact of climate. If your business has affected in different ways in different parts of your business, then try and explain and those differences. Be as specific as possible. Don't talk in broad generics. Identify specific risks. Explain precisely how it impacts on your decision making. Importantly, there should be balance. And certainly one thing that they identified in the sort of high risk 25 companies was a focus on opportunities. And so you've got to get the balance right. TCFD isn't just about risk, it's about opportunities, because your business strategy might be able to develop and improve, and there may be niches in the markets you can exploit by considering climate change. Again, that's one of the benefits of really taking TCFD and similar disclosures to heart. When it starts influencing you, being at the board level, then you can find opportunities as well as manage risks down the line. And it isn't just about integrating with your thinking; it's integrating with the rest of the report, which is the third piece. You'd be talking in your strategic report about business model. You'd be talking about principal risks. Well, if you're identifying some of these as climate related, make sure that there's a consistent narrative and it fits together as a coherent whole. Explain how you've decided what to put in the report. So really a question of materiality. How did you determine what to include and what not? And how did you take the layers of TCFD guidance into account in developing your reports? And finally, there will be connectivity between the front end and the back end. So if you are making assumptions that impacted on your climate-related forecast, well, then they should be making their way through and be reflected in cash flow forecasts, impairment reviews, etc., that drive the financials. So moving on to what the FCA found, their review was much broader, 171 premium listed companies, and didn't focus purely on those sort of high-risk sectors. And I think it's whilst they did see improvements from previous years, because a number of entities did do TCFD voluntary, there were certainly some key areas of concern. And I think the one that if you are required to do TCFD now, or you're required to do TCFD as it becomes part of the legislation, as we say this for larger companies, even if they're not listed, then the key element to make sure you get right is that there is the statement of a clear statement of compliance. Now, it is at the moment done on a comply or explain basis. But what you should do is that statement should be very clear on which of the 11 disclosures have been made, which ones haven't, why not, and what you're doing to address it. They have really focused on their concerns where they have reviewed accounts and those statements were vague or inaccurate or misleading. And it says here they're considering these cases may take further action. We know they are taking action. Even if the first step of that action is writing to companies where they feel their compliance statement or those disclosures have been inadequate, but they're certainly hold in their pocket the possibility of sanctions. And so that point about being transparent on exactly what you've been able to meet, what you haven't been able to meet, and why not, and how you're going to address that going forward. That transparency is what investors and users want, as well as what the regulators will focus on. They identified, move on to the next slide, sorry. There are more detailed findings. As I said, I put those 7 disclosures in a red box. These are the ones which they expect compliance with, that everyone should be able to explain how it fits into their governance processes, what their risk management processes are, and at least the first 2 of the strategy disclosures. The ones that they realise will be more difficult is the 3rd of the strategy pillar, which is about scenario analysis, considering the impact of the business on different levels of temperature change, climate change over the coming years, as those skills and that knowledge needs to be developed. And they also recognise that perhaps metrics and targets aren't yet in place. That's for now. They will get tougher over time. They also stress that, look, the TCFD 11 recommendations is not the only thing. The listeners also referred to you need to take into account what's known as the TCFD Annex. And that Annex has a lot more detailed guidance on getting behind those headline disclosures and considering what disclosures would be needed to effectively meet them. They don't specify they have to do all of those, but you really need to be reading it and taking it into account. Similarly, their guidance on metrics, targets, and transition plans, particularly where you are making net zero commitments. And this is what I just want to mention, because many businesses say, well, they're committed to achieving net zero. But what does that mean? I mean, by when? How are you measuring net zero? Is that just in terms of your own activities, or is it including your suppliers, or is it the entire value chain, which, from those who supply to you and where your products move on to? And does it rely on the purchase of carbon credits? And how will the benefit of those be measured? Both regulators are concerned about vague and potentially misleading statements about on being committed to net zero that are not and fully understood or indeed fully applied. They go further and say that TCFD is just one stepping stone, and it's a stepping stone to much broader sustainability reporting. And the next step in that will be moving to the more sort of detailed requirements in the IASB's proposed standards. The exposure draft period for those is over. The IASB is considering responses, but the FCA and the government are committed to having IASB incorporated into UK reporting as part of a broader move towards greater sustainability reporting for all. And then finally, the FCA encourages companies to consider SASB. Well, that's a board, it's now defunct, but all of its work and indeed many of its staff and board members have been subsumed into the IASB. And so again, that's looking forward. That's the FCA looking forward and saying, you need to use metrics. Here are some good ones, and they will form part of what you'll be required to do in the future. Moving on. Just a few points about some detailed findings. You know, on average, these are coming out at 5 pages when they're in the annual annual report. But the range is huge, between 1 and 30 odd pages. But I think if you look at that being an average of 5, that shows that you must be thinking thoroughly and explaining fully there will be expectations of that, and to be at kind of market benchmarks. And they identify that that the ones which are most difficult to apply were missing, and whilst they expect everyone to be able to do that 7 of the 11, they noted that only 81% indicate they had, and even then their concerns over some of these compliance statements probably bring the numbers down. FCA are taking action this year, but relatively soft, and only in the most kind of egregious cases of sort of misleading statements. They will build on their monitoring and their actions in future years. Moving on. And again, the left-hand side there, it's really just what I was talking about these net zero statements, their concerns about those. You know, as that quote, I think is important. We observe that these were often not clear. In some cases, they risk being misleading as a result. If they or the FRC, in other cases, were to be seeing these statements which were potentially misleading, they will raise that and take whatever actions they deem necessary. As I mentioned, incorporated into risks. Many are doing this, at least in terms of emerging risks. And I think there is an expectation amongst users that you are taking these risks seriously, and you're able to explain and show you're managing it, even if it is a risk for the future. Moving on. So that's what the FRC and the FCA have been looking at. Hopefully gives you some thoughts on how you can work on yours. If you aren't yet doing them, you know, that gives you a sort of a blueprint for the kind of reporting that you'll be expected of either next year, if you fall within the new legislation, or future years as we see this move out as the government have indicated they would. Final point, just a little pointed towards an FRC reporting lab, FRC Financial Reporting Lab project, which is about how do you get the data for ESG reporting. I won't go into the detail of this, but it is a useful report of looking at what is happening today, how it could improve, capture and control information better, because there's clearly a big differential between the quality of systems and controls over financial information and those over ESG. Given the importance the market is placing on that data, you know, systems and controls are going to be needed. And when we look forward, when we can genuinely expect some level of assurance being required over the front end, well, that assurance will only really be achievable if good systems for data collections put in place. So, useful report to help you on that journey, and including a podcast, and that talks you through those findings. And that's it for me. I hope that was useful, and I will pass back to Moses.
Thanks, Anthony. So now, in this last bit, sort of the last stretch of the webinar, we'll be basically looking at FRC publications. So, Ben, if we move on to the next slide, and the next one, I suppose. Yes. So we're starting off with thematic reviews. Now, most of you will be familiar that this is the time of year where the FRC produce their thematic reviews, mainly coming out from either topics that they've chosen to research, or perhaps out of the reviews performed by the corporate reporting review team. We're talking here today about a couple of them, judgments and estimates one, and earnings per share. There are two more which we hope to cover in the December webinar, which are on business combinations and deferred tax. And we'll also be looking at their annual review of corporate reporting in that webinar. But dealing with the judgments and estimates, one first. So the FRC have already done a thematic review back in 2017. So this is an update, and it was rather more limited in scope. They focused on three focus areas. The first being the use of sensitivity and range of outcome disclosures. The second one being mineral reserve estimates, and lastly, judgments and estimates relating to climate change, which sort of dovetails quite well with what Anthony was talking about just now. In terms of what they found, improvement in the quality of disclosures has been noted. I suspect that's because they've been banging the drum about it for the last few years. Typically, accountants, I think, we tend to find don't like to write narrative, and judgments and estimates is about narrative, but there's clearly been a push to improve those disclosures, and they're now more detailed and granular. I suppose in the past, the FRC was saying that these were rather boilerplate. They're also finding that estimates are now supported by quantification, whether that is identifying the number that's at risk, or the subject of the judgment, or sensitivities, and then they're also finding a bit more integration of disclosures with the rest of the annual report, both the front and the back end. But as usual, there's always a could do better. So if we move on to the next slide, we'll see what bits the FRC highlighted that they think could be done better. And this slide we're mainly dealing with estimates. So again, this isn't, I suppose, new stuff in terms of it's required in the standard, but the FRC are just making the point again as to what they expect to see in a good estimates disclosure. So firstly, you've got there, specify which estimates have a significant risk of material misstatement. If you've got an estimate that really the range of outcomes is fairly narrow, you don't need to cover it. You then, well, like I said, then quantify the amount and give sufficient granularity. So I know that they said that they found better granularity. They're clearly not finding enough of that granularity in the descriptions of the assumptions and or the uncertainties. And also they've also mentioned, well, sometimes, last year you'd have said this was subject to uncertainty. Is it still subject to uncertainty or not? They also say, well, entities should update their disclosures in this regard. In terms of the sensitivities that you then give, it needs to be meaningful. So, if a 50% change in the balance is unlikely, then don't mention that. Mention one that's more likely to happen. And also, in cases where those estimates are significant, quantify those assumptions that you've used. Why? Because that way, a reader of the accounts who's interested in well, what's at risk here could do their own risk analysis or analysis to understand what those outcomes could be, and also the interaction of some risks with each other. And then the point we've got there in the middle of the slide, that the FRC are not discouraging the disclosure of estimates that perhaps might not have an impact in the next financial year, but they are encouraging that is disclosed separately from the estimates that and judgments that are required by IAS 1. So moving on to the next slide, in terms of significant judgments, again, the FRC have been sending out this message consistently over the last few years, and about showing those judgments separate from estimates. So if you've got a judgment that's more, let's say, about the application of an accounting standard, or which standard your a transaction is in scope of, don't lump that all with estimation uncertainty. Show it separately, and those disclosures need to be specific and on the material ones. So again, if you have two potential accounting outcomes, but the outcome isn't too different in terms of how it would impact results, then there's probably no need to give that or to disclose that as a judgment. Then in respect of climate change, again, it's about assessing whether those risks, those climate change risks, fall within the disclosure requirements. They may not, because they may be longer term. Again, the FRC are not discouraging that, but it's about the disclosure being clear that this is a more longer or medium term risk than the other ones that you're disclosing. Okay, moving on to the next slide. So this is now a thematic review that the FRC have prepared on earnings per share, and it's rather more limited in scope in that it's just a single standard and not as wide ranging, and sometimes from the disclosures anyway, it's harder to draw any specific conclusions. But clearly, the EPS is a key metric used by investors and management for decision making, and what the FRC came away from in this review was that it can be challenging to apply, and that they've sometimes asked questions on EPS disclosures, which resulted in restatements, which has led them to believe, well, there's probably some either knowledge gap or application gap here that needs to be addressed. And this thematic review is more, a watch out for the pitfalls rather than this is what people are doing right and wrong. So if we turn to the next slide, what issues did they find? So one of them is calculating the average number of shares. Now you would think that shouldn't be too hard, but clearly from their review, they found that the application of that does perhaps have some pitfalls. There's rules in IAS 33 about share splits or bonus issues, or share splits that contain bonus issues as well. And what that requires is that it requires retrospective restatement of previously disclosed EPS figures. And interestingly, if you have a share reorganization post period end, that is an adjusting event for the purposes of IAS 33. So you would disclose your current year EPS figure based on the new number of shares following the split, shall we say, and also restate prior years. Another area is contingently issuable shares. These are likely to occur where you've got a share-based payment arrangement subject to performance conditions which have been met, and there's a little or no exercise price. Again, the standard there is explicit, that says these are included in the calculation of basic earnings per share. from the date when all necessary conditions are satisfied. Again, the FRC found that they were being omitted in some cases. Now, there may have been a good reason. For example, the directors had formed a judgment that it wasn't a little or no exercise price, but if that's a judgment that needs to be disclosed, then that needs to be clear. Or equally, if they were being included, it wasn't obvious when you looked at the numbers how that weighted average number of shares was being disclosed. So perhaps improved disclosure of how the weighted average number of shares was arrived at would help. They've also found that where there are treasury shares or own shares held by an employee benefit trust, in some instances, these are required to be omitted from the weighted average number of shares. But again, the FRC found that this wasn't always the case. So moving on to what else did they find? Well, the definition of dilutive and anti-dilutive shares, and here I'm going to give you a reference to page 20 of the report. If there's a page that you read out, I suggest it's that one. It is really quite good in terms of explaining when a share or a potential ordinary share is dilutive or anti-dilutive, and in terms of specific issues that were found, where you've got continuing and discontinuing operations, the continuing operations profit is the number that's used as a control number to establish whether potential ordinary shares are dilutive or anti-dilutive. So if, let's say, you have a loss from continuing operations, then it is likely that all of your potential ordinary shares will be anti-dilutive. So you would expect then basic and diluted EPS to be the same for all measures, continuing, discontinued, and total. But again, the FRC were finding that that's not the case. And the next point on the slide just follows on from that one. When a loss is reported for continuing operations, then the diluted loss per share cannot be lower than basic per share. But again, the FRC found that not everybody was familiar with this. So this next slide is dealing with alternative performance measures. When people present an adjusted EPS number, apart from the normal rule that you need to disclose and explain the APM in accordance with the ESB guidelines. The FRC were finding that people are only disclosing one measure of adjusted EPS, normally diluted, I think, but the point is that you've got to disclose both. They also found that in some instances, the weighted average number of shares used was different to the one mandated by paragraph 73 of IAS 33. So again, worth a read, just to, if you do present an alternative performance measure that's a per share measure, because there are a few potential pitfalls on the way. Then also, if you're disclosing, let's say, an asset per share measure, there's an expectation that companies will comply with the requirements of IAS 33, paragraph 33, with the exception of the calculation of the denominator, because that's normally done on the basis, say, of a year-end number of shares. But again, whatever numbers you put in, if they're not the ones that are required by the standard, you should explain them. And if the ones that are required by the standard are ones that are not obvious from other disclosures, say the share capital note, there probably ought to be an explanation of how those numbers were derived, which I think leads me on to the next slide. And I think I've covered the first point in terms of expectations, the FRC's expectations. Disclose how you've arrived at your weighted average number. If it's not obvious from the share capital note, if there are any judgments, when or whether you include potential ordinary shares or contingently issuable shares, think about whether you need to disclose that either in the share capital note or in the EPS note or in the judgments and estimates piece. And then there's a another point here, which probably we don't see too often, where preference shares are classified as equity. You need to adjust the earnings numbers. So that takes us to the end of the thematics. Like I said, we've got 2 more to cover in the December webinar, but other FRC news. So the FRC have issued a practice guidance for company meetings. Again, this is a rather short document, just 13 pages, but it's probably useful for companies and shareholders to set expectations as to what a properly run AGM in the main, but any other company meetings that involve shareholders, what what that might look like, or what it ought to look like, and this is building on again from Section 172 duties and effective stakeholder engagement in this case with shareholders, this guidance sets out 6 principles that ought to be adhered to for before, during, and after the meeting. Before the meeting is about being clear in the communications as to how shareholders can attend and participate, and that they have the ability to engage. For the during the meeting, it's about ensuring that the board give updates to shareholders on linked to strategy, performance, and culture, allowing also attendees to raise questions, and for those questions to be moderated effectively. Also dealing with voting, being clear as to how votes are going to be cast, and then afterwards, after the meeting, is to being transparent and giving summaries making summaries available to shareholders, or written answers. So then this last thing is the FRC Lab report on digital security risk disclosures. And again, this is more about the FRC highlighting, well, the business world or business environment has changed over probably the last 20 years, but definitely over the last 10, even 5 years, and digital risks are now much more prevalent and ought to be more front of mind for boards. And again, I'm going to refer you to one page 26 of this report, and the headings that you'll see on that page are similar to the ones Anthony had up when he was discussing TCFD, and that's strategy, governance, risk management, and events, as opposed to metrics. So that last one is different from the TCFD, but ultimately it provides a framework for companies to manage their digital risk, but also communicate to investors how those are being managed, and if there has been an event, a digital event, I don't know, a cyber ransomware attack or something like that, that is there's a framework for communicating that to shareholders, to stakeholders. So I suppose that's it in terms of what we've got for you today. I think there's a question or a couple of questions, Annie.
Yes, so we've just got one question for Anthony on TCFD. So we've been asked for non-premium listed businesses, when does the TCFD reporting become mandatory?
Thanks, Annie. Well, for it, we're always going to be a little bit careful with terminology. So it's if we talk about those listed on the full London Stock Exchange, so standard listed companies listed on traded on that, then that's mandatory for years commencing 1st of January 2022. So December year ends as they're coming. If we're talking about more broad notion of publicly traded and thinking there of AIM companies, well, large AIM businesses will have to follow the new legislation, which applies for years commencing on or after the 6th of April 2022. So that's not all AIM companies, those which are large, mainly more than 500 million turnover. So yeah, if we're talking about full listed but not premium, so in other words standard listed, that's this calendar year. If we're talking about broader notion of publicly traded, including AIM companies, well, the largest of those, it will be mandatory for years commencing the on or after the 6th of April 2022. So if we're talking calendar years, for example, that would be the 23 December year end. Hopefully that meets the questioner's needs.
Yeah. Thanks, Anthony. Well, I suppose that brings us to the end of today's webinar. So thank you for joining. We hope you've found it useful. As I said, we're holding a webinar in December. At the moment, we've penciled the 8th. So if you want to pencil that date in your diaries for 12 o'clock, and hopefully the invitations should come out closer to that date. So thank you all for joining and enjoy the rest of your day.